For more on the markets, let's welcome Tyler Ellegard, president of Gradient Advisors, onto the show. Good to have you. Thanks so much for joining us.
Thanks for having me.
So it's an interesting day. I'm not sure what you make of what we saw with U.S. Markets in particular today, but obviously a lot of conversation around AI expected to disrupt, potentially dominate some industries like the software industry. But why have we seen tech stocks pulling back so much so far in 2026?
I mean, it's just the pure threat of AI taking over the capabilities of what those software services are offering, right? You can go to ChatGPT or Claude or Grok or any of the other ones that are out there, and you can ask it literally anything. Now, the question becomes, do they have the right answers, and are they the correct answers? So there has to be some knowledge there that you can't just ask it anything and everything. But the general sense is that AI can take over whatever the service is that these software companies are offering. And so that's why you're starting to see these software stocks actually pull back. And you can get into some of the other sectors as well that are pulling back off of the concern over AI and what it's going to do or potentially do. Mm-hmm. I'm not as concerned about that right now. I think we do have to see some of these companies punch back a little bit, if you will, in terms of how they're going to utilize AI for the consumer, how it's going to make their platform better, how it's going to enhance the capabilities of their platform for the user. So there is going to be some winners and losers, but I think generally speaking, I'm not as concerned about what the market is telling you for these software names right now.
And you say a lot of these companies, because as you mentioned, software in particular has been hard hit. We've seen this year, real estate, though, trucking as well, financial services. You say they need to punch back. How so? What should they be doing?
The type of investment that they're going to be making in AI to utilize on their platforms, or the growth trajectory of their firm or their company, despite the concerns over AI, right? All you hear about is what AI is going to be doing and the capabilities of it. We haven't yet really heard about how these companies are going to make their platform better or enhanced versus what the AI chatbots are going to be able to do right now. So that's what we really need to start seeing.
Do you think that's something investors should be cautiously kind of aware of at the moment?
Absolutely, yeah. It comes down to there will be winners and losers. And so you have to, again, the challenge of it is picking the winners versus the losers. But again, there will be winners that come out of this, the companies that do utilize AI or showcase that their platform is better than what AI can give you. There will be those companies, and those are obviously going to be the winners. Now, again, there will be some of the losers that might just rest on their laurels and not do the punch back that I'm talking about and just let AI take over what they're doing. Obviously, most companies will try not to let that happen. But again, there is going to be a big difference in the companies that are willing to put in the investment and showcase their platforms versus AI.
We've heard a lot about these, big like hyperscalers spending a lot in terms of AI. We've seen a lot of reports coming out, like quarterly reports, and AI spending is very big. A lot of investors cautious about that. Do you think the spending is justified, or do you think these big companies should also be cautious about how much they're spending?
I would say it's justified right now. Again, we don't know what the total return on investment is going to be in the next 5 to 10 years. But they have to spend to try to get a better return on investment. And so right now they are spending, and it is what it is. But I think at this point, it's one of those things where these companies aren't, especially the hyperscalers, aren't necessarily focused on the current capabilities of AI, right? We already know who the winners have been in the current AI space. What they're investing for is advancing AI forward into the artificial general intelligence, or AGI, and whoever can get there first is going to be the winner. Just like oftentimes right now when we talk about AI and chatbots and what is AI right now, I hear a lot of people talking about ChatGPT. It's just referred to as ChatGPT, just like Kleenex is referred to as tissues. So it's who is going to be the winner and who's going to get that return on investment first. That's what they're spending for right now. And so it's a lot, don't get me wrong, but I think at the end of the day, they almost have to be spending this type of money right now.
Yeah, that's an interesting way of looking at it when you mentioned ChatGPT. Aside from the success of AI spending that we're seeing right now, whether it's justified or not, what other factors do you think are contributing to the kind of market anxiety we're seeing right now?
Yeah, I think there's a lot of concern around U.S. consumers, number one. some of the data isn't necessarily showing that consumers are, we hear a lot of times U.S. consumers are struggling. We're not necessarily seeing that in the data, but we hear about it a lot on the lower end of the income cohorts. And so I think the markets are concerned about that and what the Fed could potentially do and where interest rates are going right now. The affordability, I guess I should say, is what people are concerned about, which is adding to some of this volatility in the markets, despite the jobs numbers coming in better than expected, unemployment coming down, all of the things that we saw last week. Despite all of that, there is still a lot of concern about U.S. consumers.
Do you think we're going to, I'm asking you to predict the future a little bit, but continue to see that concern when it comes to U.S. consumers throughout maybe the first half of this year? I
do. I think, especially, you have to bifurcate the consumers that you're looking at, right? Because the market is more about what the earnings potential are for the companies versus the economic side, where you could be having some of those lower income cohorts really having affordability issues right now in the U.S. And I think both can be true at the same time, where you get strong earnings growth, but you have some weakening consumer ends, and the market continued to go higher despite the economic side of it. So I think the volatility in the markets and the concern over U.S. consumers continues at least throughout the first half, if not into the end of the year.
Okay. You also mentioned the Federal Reserve and rate cuts for the rest of the year. So I'm wondering what your prediction is in terms of what we'll see there. Yeah,
look, I've had to change my thought around this a few times here. And the reason being is coming into the year with some of the changes for the Federal Reserve and the board members, I was expecting more rate cuts towards the end of the year, call it 3 to 4-ish. Now I'm pairing that back with who President Trump is appointing as the Fed chair. That shocked me a little bit. Maybe that's the conversation for another time. But I think the Federal Reserve, I would say 1 to 2 cuts right now is the expectation on my end.
1 to 2 cuts. Yeah. Okay. We could talk for a lot longer, but that's all the time we have. Tyler Ellegard, president of Gradient Advisors. Appreciate your time. Thank you.